Here's a fact that should keep you up at night. In September 2006, the IMF's official World Economic Outlook declared global financial risks were broadly balanced. 18 months later, the world's financial system nearly ceased to exist. The common belief is that crises announce themselves, that smart people will see the cliff before we drive off it. They won't. They never do. Because the next collapse isn't hiding in a failing bank or a crashing stock market. It's buried inside the architecture of the financial system itself, in a mechanism so deeply embedded that the people running it don't fully understand what they've built. And here's what's truly disturbing. The system has already started breaking. You just can't see it yet. But by the end of this, you will. In 1954, an economist named Hyman Minsky was sitting in a Harvard lecture hall watching his professor, Joseph Schumpeter, describe how capitalism moves in cycles of creation and destruction. Minsky walked out of that lecture with a question that would consume the next 4 decades of his life. What if stability itself is the danger? It sounds like a paradox. Stability is what we want. Stability means jobs, growth, rising markets, confidence. But Minsky watched cycle after cycle and arrived at one of the most unsettling conclusions in the history of economics. He called it the financial instability hypothesis. And it goes like this. When the economy is stable for a long time, people stop being afraid. And when people stop being afraid, they do something extraordinarily dangerous. They borrow. Not recklessly at first, cautiously, even prudently. A business borrows to expand because the economy is growing and the interest payment is comfortably covered by operating income. A bank lends because default rates are low and the loans look clean. Investors buy assets because prices have been rising for years, and it seems rational to expect they'll keep rising. Everyone is behaving sensibly. Everyone is following the logic of the environment they're in. But here's what's actually happening beneath the surface. Every year of stability makes debt cheaper, lending looser, and collateral requirements lower. The banking system slowly shifts from what Minsky called hedge finance, where income covers both interest and principal, to speculative finance, where income only covers interest. Then finally to Ponzi finance, where the borrower needs asset prices to keep rising just to stay solvent. In the critical detail, nobody rings a bell when the transition happens. There is no announcement. There's no warning label. The entire financial system slides from safe to fragile, while everyone congratulates themselves on how stable things look. Minsky died in 1996, largely ignored. His peers considered him a pessimist, a contrarian, an economist of the fringe. Then 2008 happened. And suddenly, every economist on the planet was scrambling to cite him. The term Minsky moment entered the financial dictionary, the point where debt-fueled euphoria suddenly tips into panic, assets get sold en masse to cover obligations, and the entire artificial architecture collapses. The problem is, everyone focused on the crash. The lesson was supposed to be about the stability before it, because here's the data that should terrify you right now. We have just lived through one of the longest periods of artificial financial stability in recorded history. From 2009 to 2022, interest rates were held near zero across the developed world. During that window, total global debt rose from roughly $200 trillion to over $315 trillion. That is not a coincidence. That is Minsky's hypothesis executing in real time at a global scale for 15 straight years. And the Austrian economist Ludwig von Mises had a phrase for this. He called it the crack-up boom, a final explosion of borrowing and asset inflation that looks like prosperity right up until the moment it doesn't. The question isn't whether the Minsky cycle has been running. It has. The question is where we are in it, which brings us to the mechanism that nobody is naming clearly. In May of 1931, a mid-sized Austrian bank called Creditanstalt published its balance sheet. The numbers were bad. Not catastrophic by today's standards, but bad. The bank was one of the largest in Central Europe, holding assets across Austria, Hungary, and the collapsing Balkan economies. Within weeks of that disclosure, bank runs spread across Austria, then Germany, then the United Kingdom. The Bank of England was forced off the gold standard. International credit markets froze. Trade collapsed. And the Great Depression, which had until that point been bad, became civilization ending. One mid-sized bank, a region most people couldn't find on a map. The end of an era. The lesson wasn't just about the bank. It was about what the bank was connected to. Creditanstalt held sovereign bonds. Governments held stakes in banks. Insurance companies held both. When one piece cracked, every piece cracked simultaneously because they were all holding each other up. Economists have a name for this structure. They call it the doom loop. And the modern version of it is bigger, more complex, and more hidden than anything that existed in 1931. Here's how it works today. Banks are required by law, through regulations like Basel III, to hold high-quality liquid assets as buffers against crisis. The assets regulators designate as the highest quality: government bonds, U.S. treasuries, European sovereign debt, Japanese government bonds, the safest things on earth, supposedly. So banks around the world buy massive quantities of sovereign debt, which means when you deposit money in a bank, A significant portion of that money is holding up the government's ability to borrow. Now, run the loop the other way. Governments facing historically unprecedented debt levels, the U.S. is currently carrying $36 trillion and climbing. Japan's debt to GDP has exceeded 250%. The U.K. is at levels not seen since the Napoleonic Wars. Those governments can only service their debt at manageable rates because banks are forced to buy their bonds regardless of yield. This artificial demand keeps sovereign borrowing costs suppressed. The bank holds up the government. The government backstops the bank. Neither can fail without destroying the other. Now introduce a variable, inflation. When inflation rises, central banks are supposed to raise interest rates. Higher rates mean existing bonds. The ones issued at lower rates fall in value. That's basic bond math. When rates go up, bond prices go down, which means every bank holding government bonds as their safe assets suddenly has a balance sheet with a hole in it. This is not theoretical. In March 2023, Silicon Valley Bank collapsed for almost exactly this reason. They held a portfolio of long-duration treasury bonds that had cratered in value as the Fed raised rates. When depositors asked for their money back, the bonds couldn't cover the gap. A $200 billion bank evaporated in 48 hours. The Fed and Treasury stepped in and guaranteed all deposits to prevent contagion. But here's what the official narrative skipped. SVB was not unusual. It was a relatively small example of a structural problem sitting inside virtually every major financial institution in the developed world. The BIS, the Bank for International Settlements, which is effectively the central bank of central banks, released a working paper in late 2023 that used language so cautious it was almost impossible to parse if you didn't know what to look for. They described duration mismatches across the global banking system and flagged that the current rate environment had created valuation losses in fixed income portfolios that remained largely unrealized. In plain English, banks are sitting on massive bond losses they haven't admitted yet because accounting rules allow them to carry the bonds at purchase price rather than market value. The number those losses represent? Estimates run between $500 billion and $2 trillion depending on the methodology, sitting quietly on bank balance sheets, neither acknowledged nor resolved. But the doom loop doesn't end with banks and governments. There's a third actor that has grown large enough to collapse the entire system from a completely different angle. Private credit, non-bank lending. What the IMF's 2024 Global Financial Stability Report called, in characteristically dry language, the fastest growing and least transparent corner of modern finance. In 2015, the private credit market, meaning lending done by funds rather than banks, outside all banking regulation, with no deposit insurance and no lender of last resort, was roughly $500 billion globally. By early 2026, that number has crossed $2.1 trillion. Fueled almost entirely by cheap money-chasing yield in the zero-rate era, private credit funds have become the dominant lenders to mid-market companies, commercial real estate developers, and leveraged buyout structures. Here's why this matters. When a bank gets in trouble, the Federal Reserve can inject liquidity, it can extend emergency credit, it can guarantee deposits. There's a backstop. When a private credit fund gets in trouble, there is no backstop. It simply stops lending. And every company depending on that credit for its next refinancing faces an immediate existential question. Where do we get the money? Commercial real estate offers the most visible pressure point. Over $1.5 trillion in commercial real estate debt, office buildings, shopping centers, apartment complexes, was set to mature or refinance between 2024 and 2026. Much of that debt was written at 3% interest rates. Refinancing it now means paying 7, 8, maybe 9%. The math doesn't work. The buildings cannot generate enough rental income to cover those payments. Defaults have already begun accelerating. But here is the Minsky point. The defaults themselves are not the crisis. The crisis is what the defaults are connected to. Those commercial real estate loans sit on bank balance sheets. They sit in private credit funds. They serve as collateral for other borrowing. When the collateral loses value, every loan backed by that collateral has to be reassessed. And when lenders start reassessing everything simultaneously, credit tightens everywhere, not just in real estate. The 1931 Creditanstalt collapse was triggered by a relatively small portfolio of bad loans. Nobody thought an Austrian bank was systemically important. The doom loop made it systemically important. What is the systemically important node today? Nobody is certain. That's precisely the point. Ray Dalio spent decades studying one question. Why do empires rise and fall? Not the political explanations, not the military ones, the financial mechanics underneath them. His conclusion was that all major powers operate on a long-term debt cycle that runs approximately 75 to 100 years. Not the short business cycles of expansion and recession that economists obsess over. The deep structural cycle where debt gradually accumulates, wealth concentrates, the monetary system gets strained beyond recovery, and the whole architecture gets reset. usually through war, depression, currency debasement, or some combination of all three. The last time the United States hit the end of one of these cycles was 1929 to 1945. The debt structure broke, the banking system failed, deflation ravaged the economy, a global war settled the geopolitical order, and the post-war Bretton Woods system built a new financial architecture on top of the rubble. That was roughly 80 years ago. Dalio's framework says we are not approaching the end of a long-term debt cycle. We are inside it. We are in the part where the symptoms become undeniable, but the system hasn't formally broken yet. The part where policymakers apply increasingly desperate short-term fixes to structural long-term problems. The part where the fixes work just enough to delay the reckoning and ensure that when it finally arrives, it's larger than it would have been. The specific indicator Dalio uses, and it is corroborated by Fred economic data, is the relationship between debt service costs and income. When a significant and growing share of income is consumed by paying interest on existing debt rather than funding productive activity, you are at late cycle. The U.S. government now spends more on interest payments than on the entire national defense budget. That figure, exceeding $1 trillion annually, is not a political problem. It is a mathematical signal. In 1933, the economist Irving Fisher described something he called the debt deflation spiral. When debt levels become so extreme that borrowers cannot service them, they begin selling assets to raise cash. Asset sales push prices down. Falling prices increase the real burden of debt, because the debt stays fixed while the value of collateral falls. More selling follows. More price declines. The spiral tightens. Lenders who were sitting on seemingly secure loans discover their collateral has evaporated. The credit system seizes. Fisher watched this happen in real time during the Great Depression. He had, incidentally, been one of the economists who declared in September 1929 that stock prices had reached a permanently high plateau. 9 days later, the market crashed. His mistake was the same mistake the IMF made in 2006, the mistake every credentialed institution makes before every major collapse. He measured the stability of the current moment and extrapolated it forward. He didn't measure the fragility that had been accumulating underneath. The fragility accumulating underneath the current system is not subtle if you know what data to look for. Corporate debt in the United States has doubled since 2008. An estimated 15 to 20% of publicly traded companies are currently zombie corporations, meaning their operating income does not cover their interest payments. They survive only by continuously rolling over debt. They are the Ponzi finance stage of Minsky's model, made visible. If rates stay high, they fail. If rates fall, inflation returns and the doom loop tightens again. Every possible lever the central bank can pull makes one part of the problem worse. That's the trap. And that trap doesn't appear in quarterly earnings reports or Fed press conferences. It only appears when you step back and look at the whole architecture at once. There's one final piece that completes this picture, and it is the piece that makes the coming crisis uniquely dangerous compared to every crisis that has come before it. Modern wealth protection is built on one foundational assumption, that different assets move differently. When stocks fall, bonds rise. When inflation spikes, gold protects you. When the economy slows, cash is king. The entire architecture of portfolio management, the 60-40 portfolio, diversification theory, risk parity strategies managing trillions of institutional dollars, all of it rests on this single assumption. In 2022, that assumption broke publicly for the first time in 40 years. Stocks fell 20%. Bonds fell 15% simultaneously. Gold went nowhere. The 60-40 portfolio, the safe allocation recommended by every financial planner in America, had its worst year since 1932. Every major asset class fell at once. Why does this happen? Because in a world where every asset has been inflated by the same mechanism, cheap central bank money, every asset is now exposed to the same unwinding of that mechanism. They were all lifted by the same tide. When the tide goes out, they all fall together. This phenomenon has a technical name in academic finance. It's called correlation convergence. In plain language, it means that when a true systemic shock hits, the diversification you thought you had disappears. Everything you own starts moving in the same direction, simultaneously, downward. The 2022 episode was a warning shot. The Fed was raising rates, but doing so while telegraphing every move, managing market expectations, and explicitly trying to engineer a soft landing. Even with all that careful management, the bond market had its worst year in recorded U.S. history. The safest asset class in existence. Worst year in history. What happens when the shock is not telegraphed? What happens when it comes from a corner of the system that isn't on anyone's watch list? A private credit fund freezing withdrawals? A regional bank in Japan failing? A sovereign debt restructuring in a mid-sized European economy that turns out to be more connected than anyone thought? The 1931 Creditanstalt answer: it cascades faster than any institution can respond. And here is the truly dark arithmetic. The Federal Reserve, the institution whose entire job is to prevent this cascade, is structurally compromised in its ability to respond. If the Fed cuts rates aggressively to stop a credit crunch, it risks reigniting the inflation that would tighten the doom loop from the other direction. If it holds rates high, zombie companies fail, commercial real estate collapses further, bank balance sheets erode, and the doom loop tightens from this direction. The policy space that existed in 2008, cut rates to zero, print money, reflate everything, is dramatically narrower today because starting from near zero rates is no longer an option. Rates are already well above zero, and the debt load is 3 times what it was in 2008. Nouriel Roubini, in his Megathreats framework, described this as the Great Stagflationary Debt Crisis, a collision of scenarios that previous economic models treated as mutually exclusive. High inflation and high debt and low growth happening simultaneously, each preventing the policy response that would normally address the others. Michael Burry, who famously shorted the 2008 housing crisis, has been publicly flagging not a single sector, but the entire index fund architecture, the passive investing structure that has absorbed trillions of dollars of retirement savings by buying every stock in proportion to its market cap. His warning: index funds create the illusion of diversification while actually concentrating assets. When investors collectively sell, they sell everything proportionally. A panic doesn't just hit bad companies, it hits everything, in size, simultaneously. The correlation shock is not a prediction. It is a structural feature of the current system, and the larger and more connected the system becomes, the more violent the shock when it finally discharges. So here's where we are. The Minsky stability trap has been running for 15 years. The doom loop between banks, sovereign debt, and private credit has grown into something too large to be backstopped by any single institution. The long-term debt cycle that Ray Dalio mapped across centuries is showing every late-stage symptom in the data. And the one thing most people are counting on to protect them, diversification, will fail them at exactly the moment they need it most. The crisis won't announce itself. It never does. It will begin in some obscure corner of a market you've never heard of, and by the time the headline appears on your phone, the window to act will have already closed. What history consistently shows is that the people who survived these moments were not the ones who predicted the exact timing. Nobody can predict the exact timing. They were the ones who understood the architecture well enough to know which pieces were load-bearing, which parts of the system, if they moved, would move everything else. You now know what those pieces are. The ancient Romans watched their silver coins get lighter every year for a century. They adjusted their mental model to the new normal. By the time the coins were bronze, they had forgotten what silver looked like. Don't forget what silver looks like. If this changed the way you see the financial world, subscribe. History isn't the past. It's a running diagnosis of the present. And right now the patient has a fever. They just haven't checked the thermometer yet.